Good afternoon, everybody. Thank you for joining us for what is my second, but now the fourth in the new Admiral Markets webinar series of Trading Spotlight. I'm really pleased for you all to be able to join us today. I see that we've got a lot of participants from really across the globe, all engaging with Admiral Markets and with financial markets, and I appreciate you joining us for this for what will be an enjoyable and interesting session. If you're watching this on YouTube or live, then please sort of give us feedback and like and subscribe, and we appreciate any insight or feedback that you may wish to provide us with. And today, as you can probably see from the slide there, what we could talk about is actually trading markets using Bollinger Band indicators. As always, I appreciate that we have a wide range of experience of people who join us for our webinars. Some people will be very experienced at trading and may have had experience of trading with Bollinger Bands. I also realize that other people may be new to trading and may not really fully understand what a Bollinger Band is and how we utilize them. Well, hopefully by the end of this session, that we'll be able to educate you and provide you with some useful insight into how to utilize them in your own trading. So, as I said, what's on the agenda? Well, we'll talk about, what are Bollinger Bands? How are they created? Also, we'll talk about, how do they work actually? What actual piece of data or information are they giving us? And I'm going to talk about how any trader can use them to build a simple trading plan. And if there's one thing I've learned over years of trading and coaching, it is that actually a simple plan executed well will beat pretty much any other kind of trading plan. I'm going to share with you a very simple trading method, the Wallace Bands trading method, utilizing the Bollinger Bands. And if we have time, okay, then we will make sure that we can try and check them out on live markets, as there's been one or two sort of developments over the last couple of days with this trading method. So, hopefully there'll be plenty there for us to cover. We've got about sort of 35 to 45 minutes to run, so there's lots to cover. So please make sure that you stay with us. As I said, if at the end we can check them out on live markets, that will hopefully help solidify everything that we've touched upon in this particular session. So about me, my name's Paul Wallace. I'm a trader and a coach, and primarily for myself, I started trading many years ago when I was a young man, and I've traded for hedge funds and for clients. Primarily, my sort of major instruments I'd like to trade are FX, indices, and commodities. And on my swing and position trades, I tend to be a dominant trend trader looking to buy strength and sell weakness. And for intraday trading, I tend to be a mean reversion trader, which is something we'll talk about in one of the future trading spotlight sessions. It's also great that you are joining us here with Admiral Markets. Admiral Markets are a truly global Forex and CFD broker with over 8,000 financial instruments. We have offices and support in over 20 countries, licensed by the FCA, EFCA, SISEC, and the ASIC. And we have, competitive spreads. Admiral Markets provide very competitive spreads during major market hours, typically 0.6 pips for euro dollar and 0.8 pips for the DAX, two of the most popular trading instruments. And they also provide the MetaTrader 4 and MetaTrader 5 platform, which are available to trade using either your phone, your desktop, or your browser. And they also provide the very useful Admiral Markets Supreme Edition plugin for clients. If you want to learn more about that, then please get in touch with your account representative. So, ladies and gentlemen, what are Bollinger Bands? I'd be interested to know of the participants here with us joining today if you have knowledge of Bollinger Bands or if you have any particular experience. If you do, by all means, just ping away there in the chat box. We always like to sort of get a good gauge of who's joining us, so that we can basically help provide the most value by sort of tweaking and making sure we target the most useful pieces of information for you. But primarily for Bollinger Bands, well, it's a pretty simple technical analysis tool, and it's effectively defined by setting two lines that are plotted 2 deviations away from a simple moving average. what you'll find is the standard setting is a 20 period moving average. So some people will use other period moving averages. You can pretty much, sort of set a Bollinger Band pretty much around any particular moving average that you would like. But what you'll find is the most popular and most common is just using a simple 20 period moving average. As I said, it can be adjusted to what preferences you may have, and I know traders will sort of utilize that and sort of tweak that towards their own concerns. And they were developed by the trader John Bollinger. So not unsurprisingly, they are known as the Bollinger Bands. So they've been around since the 1980s. As I said, they're a very popular tool. They're very quite a simple tool, okay, to once you know how to understand and utilize them, and they are a very helpful tool that can be added to your trader's toolbox that you can take away and utilize in your own simple trading plans. So, what does a Bollinger Band look like? So remember, as we were saying, is that it's effectively two bands plotted 2 standard deviations away. Although you may wish to change that yourself, the standard setting is it's a 20 SMA here, which we can actually see. Let's use our wonderful tools here, okay, to sort of draw in. We have here a simple sort of 20 period moving average. And we have an upper band here, the blue upper band, okay, which is plotted 2 deviations away to the north side, and then a lower band here plotted 2 deviations to the south side, to the lower. And this is what creates our band. This is what creates the sort of Bollinger Band. As you can see there, okay, this is a chart of the sort of the DAX on the daily, but really a Bollinger Band can be utilized on any particular instrument, all right? Any particular instrument, because it's effectively just plotting the two deviations away from the 20 period moving average. And as I said, some people like to tweak in terms of what moving average they use and also the sort of number of deviations away. But the standard sort of setting is 20 SMA with 2 deviations, and that is what the standard setting up on both the Admiral Markets MetaTrader 4, MetaTrader 5 platform will have, and hopefully we'll get time to be able to show you that towards the end. So, what do the Bollinger Bands tell us? How can we utilize them, right? Well, as I said, they're a very popular trading technique. And what becomes of interest to us is that approximately 90% of price action occurs between the 2 bands, all right? Just think about that. 90% of price action occurs between the 2 bands. And many traders, right, there's sort of the general consensus would be that believe that as price reaches the outer bands, that price is entering into overbought or oversold territory. And it can be very useful to help that, to understand that. But just also caveat that, like any indicator, just because it's moved into overbought or oversold territory doesn't mean that it's just going to automatically reverse. An instrument could be on a really strong trend, and even though it's in overbought or oversold territory, may actually continue with that trend. So as a kind of a trader tip, we always caveat that when you're using any kind of indicator that indicates overbought or oversold territory, it's not an automatic sort of opportunity to sort of trade the other way. Just make sure that you have a confluence of events going on, something we've talked about in the past in our Admiral Markets webinars. We actually need 2 or 3 things to come together, and that's what I'm actually going to share with you later in this particular presentation. So, but what Bollinger Bands are good is that they're showing when markets are range bound, which is, in terms of Bollinger Bands, that's what we'll talk as contraction. That's what we've been known as contraction. And they're also good at showing when markets are becoming more volatile, when there's a new movement in the market and maybe a new trend might be about to begin. And this is what is known as expansion. That's what we will term it as for this particular presentation. So here we have a market that is, pretty range bound. We can see it's what we would call contraction. You can see that pretty much from left to right, the market is mostly going sideways, all right? And, what helps us, the Bollinger Bands help us in that we can see that, the bands are pretty much going sideways, and also the bands are narrow, all right? They're showing contraction. So with being able to read price action and also utilize the Bollinger Bands, it just helps confirm that, yes, this particular market is in a contraction phase. It's range bound, okay, it's going sideways. And so if you're a trend following trader, well, then this is probably not the market for you to be engaged with. Alternatively, if you particularly like to trade range-bound markets, well, this is where you get the opportunity to fill your boots, to get stuck in, to actually engage with your range-bound trading method, and that's how one of the ways Bollinger Bands can help us. But we also said, we've just looked at contraction. We also have expansion, and this might be new to people who've never looked at Bollinger Bands before. Let me just bring up my drawing tool here. We can see here that, there we go. We can see here that, the markets were pretty much going sideways. We were the Bollinger Bands were, very narrow. But as price changes direction and changes in terms of its volatility, we can see that actually the markets, the Bollinger Bands, start to expand. We can see they actually start to grow, and that is an indication of that, we're expansion. We've gone from contraction to expansion. It's the start of a new trend, and actually we can see that, the price actually continues down pretty significantly. And this is, as we were saying, just because as it's expanding, and it might be giving an indication that the market is, in a new trend, or perhaps even becoming oversold. In this case, that is not just an indication that we just need to reverse our position. There's more to it. We need to be a little bit more, have a little bit more finesse, a little bit more elegance in the way that we look to trade, and that's what I'm going to share with you in a few slides' time. But hopefully you can see that, the difference between, a sort of contraction phase and then an expansion phase there. Hopefully you can see that and how that actually sort of represents itself on the chart using Bollinger Bands. So what's that Bollinger Band telling us? Well, the underlying premise is that markets move from contraction to expansion. You can call that whatever you like, contraction, expansion, surge, then rest and surge. What you can see there is, when markets are very quiet, going sideways, range bound, and then when markets are, expanding into new trends. So, not unsurprisingly, when markets are contracted, trend following traders are waiting for expansion. And when markets are expanded, range-bound traders are waiting for contraction. That would kind of hopefully make sense based upon what we've just looked at there on the charts. And part of it is about knowing, knowing your understanding, your market and what particular phase it's in, but also knowing, what your trading method is like, whether you have a trend-following method or whether you're using a range-bound method, and being able to sort of make sure that you are, utilizing the right trading method in the right trading phase. So, how can we use them in our trading? How can we sort of, as always, sort of turn that into a trading plan? Well, it is possible to use Bollinger Bands to create trading strategies for both, for both periods of contraction and expansion. And today what I'm going to do is I'm going to show you kind of a simple visual sort of mean reversion trading strategy that you can utilize with your trading using Bollinger Bands. We're going to call it the Wallace Bands, and it's primarily, it's sort of it works best in periods of contraction. And as we know, as much as many people like to trade trends, but we know markets only tend to sort of trend 20 to 30% of the time. So whilst this the Wallace Bands could be used in sort of trend trading phases, tends to work better when we have markets working in a contraction phase. But we'll see for a few examples, and you can basically get a little bit of a feel and understanding of how that might look for yourself. So here's our setup, okay? Here's our trading method setup. For those of you who are swing traders, okay, like myself, primarily a swing trader, we're going to be using a daily chart, which I'll show you on the MetaTrader platform in a moment. Intraday traders, okay, for those of you who like shorter term trading, then you can use a 60-minute chart. And we're just going to use the standard Bollinger Band settings, all right? 20-period moving average with 2 deviations, and I will show you how to set that up on the charts in a moment. But it's just a pretty standard, simple setup. As I said, people do like to tweak it and amend the Bollinger Band settings, and that's okay if you can be able to have the ability to tweak and then back test your ideas. I say, absolutely fantastic, go for it. But for ourselves here today, with what we're going to be doing is just using simple Bollinger Bands with the standard settings. So part one, okay? Part one is that we want to see price close outside the Bollinger Bands. Now let's just draw on here as always. We can see that in this particular example, we've got, here's the 20-period moving average, here's the lower Bollinger Band, here's the upper Bollinger Band. We can see here on this day, price actually, it did go up and touch the Bollinger Band, but it actually came back and closed within the Bollinger Bands. Whereas actually the next day here on this daily chart, price actually pierced the Bollinger Band, but it also, here we can see, it also closed outside the Bollinger Bands, okay? It closed outside the Bollinger Bands. Remember what we said a few slides back, 90% of the price action takes place within the Bollinger Bands. So when we get a close outside of the Bollinger Bands, we're into new territory. We're into new territory, okay? This might be where people might start to think that, in this particular case, that we are into overbought territory as this particular instrument. So the second part of this is then we wait, okay? We wait for the next day to see if the next candle is a reversal candle, which must also close back within the bands. So here was our candle one, which we could see closed, all right, outside of the upper Bollinger Band. This next day, the next candle we can see was a reversal candle in the sense that it also closed. It's, we've gone from bullish to bearish, and we've also effectively closed back within the bands. So prices basically popped up and it's come back in, okay? That's what we're looking at. So, the first candle closes bullish outside the bands, then the reversal candle must be a bearish close back within the bands if we've been hitting the upper Bollinger Band, getting ready for a short. Or alternatively, if price had come down to the bottom band, then if we have a bearish close, okay, outside of the bands, then the next candle must actually effectively close back up within the band, okay? There you go. I'm just drawing that in there quickly. You'll be pleased to know, ladies and gentlemen, that I'm a much better trader than I am an artist, but hopefully you get the idea. So please bear with me with my poor artistic talent there. So, but hopefully you get the idea of what we're actually trying to look at. And if it does, well, the trade is on. We have a trade, okay? That's what we're looking for. So it's quite simple. It is actually quite a simple idea, okay? Price pushes up to the pushes up in this case pushes up to the upper Bollinger Band, closes outside it, then next day reverses and closes back within it, okay? That is the premise of the setup. That's the simple. As I said, it's a very simple trading plan, but invariably that can actually be what works best for many, many traders. And it helps them because it's unambiguous, okay? The price is either on the one day closed outside the Bollinger Bands, and the next day it has a close back within it. It's very clear. There's no ambiguity, okay? As traders, we don't really want ambiguity. We want to be able to have very clear, simple, precise trade setups that we can follow. So once the reversal candle is closed, we enter at the market in the direction of the reversal candle. So if in this particular case here, okay, we closed outside and then we close back inside. So we're going to be shorter. We're going to be selling. Okay, we're going to be selling. We're going to be selling at market. Okay, so on a daily chart, that might be at the end of the day or the start of the day, depending upon where your what period of the globe you are and where your actual candle closes. And what we look to do is, we will put our stop loss in place, and our stop loss, for this case of the short, goes above the high of the preceding two candles. So we've got here's a trigger candle, here's the preceding candle, so candle one, candle two. So we find out where's the high of this, and then we put our stop about 20 pips or 20 ticks above the high there. And the reason we do this is to effectively, this helps us to kind of avoid any sort of whipsaws or any kind of stop hunts that might occur if price does just try and push back up. Okay, it means that our stop loss is safe above it. But what it also means is that, you know, we are managing our risk. If price was to turn around and then shoot back up, well, then our trade idea is, you know, is no longer valid, and we don't want to be in the trade anyway. So we're trying to sort of, you know, manage our risk, okay, manage our capital, and important, of course, remember that to always position size your trade. If you're unsure of what position sizing is, well, then, you know, if you'll join us for one of our future sessions, we'd be happily going into that and talking about that in great detail. But you will also be able to find it in the Admiral Markets webinar archive there. If you can check that on the YouTube channel or on the Admiral Markets Global Facebook page, you'll find there are quite a few previous webinars there that would actually give you some insight into how to position size your trade. But, you know, here we are for today. We're just looking for a trade setup. We just make sure our stop loss is, you know, for a daily chart, which is what, you know, we're going to focus on for today, is like 20 ticks, 20 pips above, or about 8 ticks, pips on an intraday. Okay, if you're trading it on the 60-minute chart, but we're going to focus mostly on the daily chart here, ladies and gentlemen. So, you know, what we have here's part 4. Part 4 is that we're going to have a bit of a belt and braces approach here, in that our target, okay, so remember, we know where we've got in, we're entering market, we know where our exit is if we're wrong, it's our stop loss above the high of the recent 2 candles. And our target is to target the other side of the Bollinger Bands. So if we're, in this particular case, if we're, you know, shorting at the upper Bollinger Band, our target will be the lower Bollinger Band. That's what we're going to be looking at. But remember this, especially on the daily and also on the hourly, is that you might need to update your target as the Bollinger Bands change. Remember, okay, the Bollinger Band is updated every day. It might be a case that we're going from a contract to expansion, or maybe from expansion to contraction. So just be sure to, you know, you'll have your target in place, but make sure that you update it, okay, and date it every day based upon what the latest Bollinger Band reading are. And I'll show you that on the MetaTrader platform. What we also do is we also have a trailing 3-bar stop. So we have a target, but we are also going to trail our stop loss by 3 bars, okay? So as I said, it's a bit of a belt and braces approach, but there are reasons for this, which I'll show you as the presentation goes on. So what that actually means for a trailing 3-bar stop, if you're new and wouldn't understand that, is that, you know, with each candle, when each candle closes, we basically move our stop behind the high of the last 3 candles for a short, or behind the lowest of the last 3 candles for a long. Remember that being about 20 ticks just beneath the low for a long, or 20 ticks above the high of the 3 candles for a short. And so we hold our trade after, it gives us, we either hold our trade until either one, our target is hit, or we are taken out on our trailing stop. So as I said, it's a bit of a belt and braces approach, but actually we do that because it works. It helps us avoid avoid getting sort of whipsawed out really too quickly, but then also gives us a nice target to aim for, but actually allows us to sort of take some profit as we go if the trade runs out of momentum. And here's just a little tip here, okay, is that for your target, okay, just make sure, you know, as I said, just make sure you update it every day, but also just have the target 5 to 10 pips inside, okay, inside the opposing Bollinger Band, all right? And that will just help take account for any spreads or any movement, slippage, etc. So just have, you know, have it 5 to 10 pips inside. So, you know, you'll just use the MetaTrader platform, work out what the latest sort of reading is, and then just basically either add or subtract 5 to 10 pips just to make sure your target is in there. You're not trying to sort of squeeze blood from a stone, because that rarely works. So, you know, here's a bit of a trade example here. Trade 1. This is the Aussie dollar, right? Okay, from a bit earlier on this year. You can see what's happened. Okay, price. You know, we had candle 1. Okay, it closed outside of the Bollinger Bands. Next day, okay, price reversed and it closed back inside the Bollinger Bands. So what happened here is we entered short at market at 72.46, and our stop loss was above the high at 73.20 there. Okay, that's what happens. Hopefully you can sort of all see that. So what actually happened is, as the days went on, as price came down here, next day it closed. This day closes, okay, and what we look back is, this is candle 1, candle 2, candle 3. Remember, we're moving our stop above the high of the last 3 candles. So that first day there was no need to move our stop. On this second day, okay, our second day our trade closed with this, then becomes candle 1, candle 2, candle 3. So our stop actually gets moved. And this is what we do. And actually after the sort of the third day, we can see there was a big sell-off here, okay, and price moved down, and our stop actually sort of moved its way down, okay. And this is what we're doing, is belt and brace. So we have a target, but actually we're trailing our stop as well, just to make sure that we're okay. And actually what happened is we didn't need to trail or stop only for a few days, because as you can see yourself very clearly, is that actually price hit the other side of the Bollinger Band at 70.70. Okay, that's where we had with it just in front of the with our target just in front of the ever expanding Bollinger Band. Remember, you can see we were going into a little phase of expansion. So hopefully you can see that how we traded from one side of the Bollinger Band down towards the other, and that gives us the trailing stop. Make sure that we are keeping our risk and managing it tightly, but also we have the opportunity, should the price move fast, to get ourselves down to a nice particular target. But actually, if those of you who are keeping sharp, keeping up there with us, will see that actually we had a second trade here. What we can see is on this day we can see that the candle actually closed outside the Bollinger Bands, but next day it didn't reverse, it didn't close out back inside the Bollinger Band, but it did once again close outside the Bollinger Band, and then next day it actually reversed and closed back inside the Bollinger Band, and hopefully you can all see that quite clearly. So as per the rules, we entered long at 70.45 here, and we also had our stop loss. Our stop loss was down here at 69.77, okay, underneath the lows of those 2 candles, and just a little bit long, just to make sure we're not giving any sort of kind of whipsaw or sharpish movement against us. And once again, hopefully, ladies and gentlemen, you can see that actually we were trading this, we were moving this, we were just trailing our stop, a 3-bar trailing stop, just very, very simply, until we actually hit the target on the other side of the Bollinger Band, okay? So actually, if you can see here, when we first put this trade on, our target would have been up here, okay, or rather just 5 to 10 pips aside, but we're having to update our target. As you can see, the Bollinger Band was starting to tighten up a bit. We were going from here from a bit of an expansion, we're actually sort of getting down towards a bit of contraction. And so we'd update our target based upon the sort of the new market conditions. And our target here there was hit just at 71.42, so that was just about 5 to 10 pips inside the actual Bollinger Band. When it got up here, it didn't actually hit its target, but a couple of days later it did. But all the time, we had a target in place. We were also just trailing our stop as per the rules. So, as always, we're happy to talk about these trading methods, but, no trading method is 100% accurate. We all wish they were, but the truth of the matter, they are not in any way, shape, or form. So just as I said, be aware when a very strong trend is in place, then mean reversion setup might not always be the most ideal. And the performance will degrade, and that's why it's always important that we use stop losses and risk management. It's always why we use have both a target and a trailing stop, just in case that the market phase is about to change Yeah, hello there, people. I'm not entirely sure what happened there. It seemed to sort of have a little bit of a pause there on the Zoom. So I apologise for that. It's hopefully you're still with us. Hopefully you can still hear my voice and see the screen. I'm not sure entirely what happened there. The internet was working fine. We just seemed to have a bit of a little glitch, but you know that's technology for you. With the best will in the world, it's that happens. It's and we're back again. So it's yeah. I apologise. I'm not entirely sure what happened there. Seemed like we had a little bit of a quick glitch, but we're back. Everyone's back in the room. I think everybody's can sort of go on. So we're back at the races, ladies and gentlemen. So as I was saying before that little glitch, no trading method is 100% accurate. You know, when there's a strong trend okay in place, then a mean reversion setup will always degrade. Hence why it's important to make sure that you use stop losses and risk management, ladies and gentlemen. That's always very, very key. So to conclude, Bollinger Bands are a very popular trading tool, and they can be used to help you show and confirm contraction and expansion within markets. Traders can use them to trade both trends and mean reversion. And what we've talked about here today is a simple kind of mean reversion system, the Wallace Bands trading method, which is just a simple visual mechanical way to trade using Bollinger Bands. So hopefully that gives you a little bit of insight. I think we've got a little bit of time. So if you'll just bear with me for a moment, I'm going to try and switch across to the MetaTrader 4 platform, Admiral Markets MetaTrader 4. And we'll have a little look through, how it just looks and how it sets up on a particular chart package. So if you just bear with me a moment, and we'll switch across. Super. So I'm hoping that you can all see my screen. Hopefully you can still all hear my voice, that that you're all still with us, still with us in the room. What I have here is the Admiral Markets MetaTrader 4 Supreme Edition platform here. What I've got here is just a couple of charts that we can talk about. For those of you who don't know how to set up a Bollinger Band, well, if you look at the indicators, here we go. We should be able to sort of just effectively go down, and under trend, you'll find Bollinger Bands. And what you'll see is the period is 20, the 20-period moving average. These are kind of a deviation of 1, but what we're looking for is actually just to have a normal sort of deviations of 2. And you're drawing that on, and then effectively, you can choose whether you want them to be particular strong, whatever color, whatever particularly, works for yourself. But in this particular instance, what we have is here, this is a chart of the dollar index. It's just a simple, normal dollar index daily chart. And hopefully you can see that, where, as we sort of talked about, 90% of the price action is contained within the Bollinger Bands. But, within that, when price bursts out of it, well, that starts to become of interest to us. So, hopefully let's go through this, even just looking at here, we had a particular couple of examples here where price, you can see here, price is closed outside of the Bollinger Band. So that starts to get us of interest. But then actually the next day, it doesn't reverse. It actually continues and closes outside once again of the Bollinger Band. But the next day we actually have, a close, a reverse, and a close back inside. So under the sort of standard of the rules, then invariably, what you'd be doing is entering the trade here, okay, and your stop would be just about, sort of a good few ticks underneath. When actually we can see in this particular instance that what happened is that trade failed. As I said, no particular trade works 100% of the time, and that will happen to all traders, okay? That was just, it would fail. But interestingly enough, on the trade that actually failed, we can actually see that once again, price closes outside of the Bollinger Band, and the next day it reverses and closes back inside the Bollinger Band. So here we have traders on. I'm just gonna basically, our traders are on again here. Just put this in to help us draw. And our stop loss is, beneath the low of the 3 candles. And actually what we see is that, the candle moves on the next day. The next day we have, you know, a bullish sign, okay, and a candle. It's a little bit, we can see there's a little bit of a definitely a bit of a volatile period there. We can see that the price has gone into, here we go, price has gone from here, from contract to expansion. And what we can see is price actually moves up. And as we close our day, what we're able to do is we're effectively able to basically trail our stop loss. That's what would happen every time we move up. We'll be moving our stop loss. And actually what happens is that, you know, in the end, I'll just draw it again, it's actually here. It's here that we get taken out, okay? We get taken out for a small profit. But as I said, this is why from having got in from here around about 96.20, we've taken out about 96.49 there, 96 just 45. So we've taken a small profit, but this is why we have the trailing stop as well as the target, because we can see price moved up and it fell down again. What you can also see here is that actually the sort of a few days ago we had a close outside of the Bollinger Band, but the next day is not a reversal candle and it doesn't close outside of the Bollinger Band. What we do have is a couple of days later, we have a strong close outside the Bollinger Band, and the next day, okay, we have a reversal candle which closes back inside. So we have traders on. The trade is on to be short, and invariably what we're going to have is entering up short at market with effectively a stop loss above the highs, and then once again we can trail that. And you can see where that is at the moment. Effectively, sort of just, you know, your stop loss is going to be trailed every day, and then actually where we are at the moment, okay, so we're just above this range of highs here. You know, and that's where, you know, the trade is in a profitable position, and that's the way it's working out, and you just let that play out, okay? Remember, the trade stays on till either we hit your target or actually your trade is effectively taken out on its trailing stop loss. What I wanted to show is that, you know, we can, as I said, just to make sure you update your target based on the Bollinger Band. You're trying to understand how to read that. Well, quite simply, you know, if you just put your cursor over the recent day, okay, we can see there hopefully on the left on the data window that it gives you the data for both the upper and the lower bands. So when I put my cursor over there, I can see that my bands 20 lower is 96.49. So, you know, on most FX pairs, okay, we'd be putting out about 5 to 10 pips in here in front of it. So for this, what I'd be looking for is have my target at around about 96.54 and update it to that, just to effectively just, you know, just be in front of the target in case you know, as I said, you don't want to try and get blood from a stone. So but the dollar index there is a bit of an example, but, you know, we can see it on, you know, euro dollar itself, that, you know, we've had not only a trade running there, but also, you know, showing you just examples of how those trades work out. And what I sort of suggest is just, you know, very simply go and test the sort of this trading method. Just open up a couple of charts, doesn't matter what they are. You can just set it on a simple Bollinger Band, and then particularly just look for how the trade's set up. And we can see here on the euro dollar on the daily chart, been a few examples here, okay, of actually how trade has worked out. If we look at particularly what we have here is, you know, here we have, you know, the candle actually closes outside, okay? Candle closes outside. So you're waiting next day to see if there is a reversal candle that closes inside. Well, it's not, you know, it's not really a reversal candle, okay? It's still a bearish close, okay? Still a bit of indecision. So it doesn't actually qualify as a setup, and this candle doesn't close outside the Bollinger Bands itself. So unfortunately, you know, we get to miss this particular trade up on that example, but that happens for all trades. We don't get closes outside the Bollinger Bands, okay? We do get a close outside the Bollinger Band there, but next day isn't a reversal candle. In fact, it actually goes even higher and closes. But then what we have is we have basically our close here, okay? And it's closed, it's a reversal candle, closed just inside of the Bollinger Bands. So our trade is on, okay? Our trade is on at around about the sort of kind of 113 sort of 12 area that, you know, be short. And what we're looking for is, you know, our stop to be above that recent high. So, you know, we've got a stop at around about 113.26, okay? That's 20 pips above the this high, this particular candle. Sorry, no, there should be 1366, okay? About 1366, 1367, okay? That's where our stop would be. If we just draw that in, it's going to be around about there. Bosh, and there we have our entry's going to be here. And so once again, you know, what we're looking for is to effectively just let that trade play out, and then every day we would look to sort of trail our stop loss. That's really all we're looking to. That's really all we're looking to do, basically. In our stop would just effectively be trailed. Okay, we'd be trailing it down about 20 points above the high. Okay, you can see it there yourself. And then actually what happens is we'd be taken out here, okay, on this candle here, once it starts to move up the next day. You know, on our stop would have been around about sort of 1270, about 1275. Okay, so we were in at about 1326. We stopped out at 1275 for around about 51 points of profit before price actually races itself back up here. Okay, back up to the here. It closes just outside. Next day, okay, next day it closes, reverses and closes back inside. And once again, we have the traders on, and this is, I'll just show you, here we go. So, you know, we're basically, you know, short on the close of that bar, the open of the next one, around about 1366, with our stop above 20 points above the high. So that gives us a stop at about 114.31. Okay, with the entry of around about 113.66, and we can see that actually this, once again, this trade just, if I just put the stop loss in here, it'll be around about there, and we can see that effectively once again we are just looking to sort of trail our stop. All right, we're just trailing our stop every day. Every day we'll be just trailing. Okay, here we go, and then actually what will be happening is as the price starts to maneuver here, we can see that would actually, as price moves here, we'd be taken out once again on this high of this moving. So that's around about 1284. Okay, that was, just making sure I know that. So around about 1284. So we got in around about 1366. We got stopped out at around about 1284 for, you know, what's that, about there's about 76, about 78, just under 80 pips of profit on that particular trade. And we can see that actually what happened is, you know, just to finish off, ladies and gentlemen, we just had here at the end of the start of the week, we had a close here, okay, outside of the Bollinger Bands on the south side. Price effectively it reversed, gives a pin bar reversal, which closes back inside the Bollinger Bands. Okay, our trade is there around about 1085, 1086 with our stop. Okay, little stop 20 pips beneath the low, so it's about 110.06. And once again, that trade has just been trailing, and here we are. You know, at the moment, okay, at the moment, our stop is just around about sort of 111.56. Okay, it's just a little bit up there. Okay, it's just a little bit. Our trade at the moment be just a stop around about here. But you know, so our trade is, you know, we're in guaranteed profit. We have our target is coming in. Remember, we can see that it's contracting. But you know, we have guaranteed sort of profits sort of stopped in, okay, in terms of our trade is just running, and we'll just let that trade run out. So I appreciate it sort of come to a little bit of the towards the end of the session. I hope you found that particularly useful. I'll just quickly finish off for the last slide or two for us. Is that you know, as always, for, you know, more analysis and education, go to admiralmarkets.com. You'll find a wide array of resources there to help you with your trading. If you want to contact us, if you've got questions, by all means, you can go through the email hello@admiralmarkets.com. See us on the youtube.com/admiralmarkets and on the facebook.com Admiral Markets Global page. So I hope you found that. Sort of useful. Okay, remember this will be this recording will be up on the YouTube channel. Okay, over the next 24 hours or so, and it's. I hope you found that useful. I hope you found that, as I said, it's a nice, simple, easy kind of way for you to be able to sort of engage with markets. And it's you know, take it away. Just go through it. It's very simple. It's very mechanical. And just, you know, try opening it up on daily charts on particular instruments, and just sort of seeing how it trades out for you. Seeing can you recognize the trade? Can you actually set the trade up? Can you manage it? All of that would actually make it much simpler for us. Thanks very much, John. It's very kind of you. I can see you there in your comments there. Thanks, thanks, Robert. Okay, thanks, Paul. I appreciate the feedback, appreciate the help. As I said, take this simple trading method away, and hopefully you'll find some success with it, ladies and gentlemen. Thanks very much for joining us.